The traditional pension will soon be gone because many people are getting into the gig economy. And when you're in the gig economy, it means you don't have an employer to match your contribution. So that means many people start saving late or they contribute too little. Irregular contributions due to job changes, due to unemployment or low income will reduce the final pension value. So what can you do? Leverage your capital. You can use mortgage to invest in property with a relatively small down payment because this leverages your limited funds into a valuable real estate asset, amplifying returns if property value rises. Lack of awareness and understanding is another challenge when it comes to pension funds. Many people do not understand how pensions work or what their entitlements are or how much they will need for retirement. So they're confused about terms like defined benefit or defined contribution plans. But with property, it's a tangible and understandable investment because you own a physical asset, a property you can visit, you can manage, or you can improve. Real estate is intuitive and visible. It offers emotional reassurance and its control is in your hands. And that control is not in your hands when you say you want pension funds. When it comes to inflation and rising cost of living, pension savings may not grow enough to keep up with inflation because the cost of healthcare and basic needs often rises faster than pension income. That you have to keep in mind. But with that, you have built-in inflation hedge, okay? Because you invest in rental property that increases rental rates over time. Property values and rental income typically rise. They go higher with inflation, so it helps you to preserve purchasing power. People are living longer, meaning pensions need to last more years than expected. Yeah? So there's a risk of outliving your savings if you go the pension route. So you need ongoing income in retirement. If you invest in property, you can generate rental income from an investment property. So that steady rental income can supplement or replace traditional pension payments completely, providing a reliable cash flow even into advanced age. What about employer insolvency or poor management? In occupational pensions, if your employer goes bankrupt or the fund is mismanaged, you as an employee, you may lose all or part of your pension. But with property, you control your own investment. You can independently acquire real estate outside employer schemes. That is why it is good for people who are in the gig economy because you are not exposed to employer bankruptcy or mismanagement. Your investment stays in your hands. The gig economy, freelancing, and contract work often lack pension benefits. We don't have anybody to match our pay. So frequent job changes make it harder to build continuous pension savings. So you may easily lose out on a comfortable retirement life if you don't have savings to carry you through. But if you invest in property, the renters will foot the mortgage. Because you buy property that is in high demand rental markets. So the tenants will help you to pay your mortgage, and by doing that, later on, that property will provide income even if your job fluctuates. So we know that pensions have tax and withdrawal restrictions. Some pensions restrict when and how you can access your money. You can take out your money from a pension scheme before you reach a certain age. Early withdrawals often come with heavy penalties or tax consequences. But with property, you can get liquidity very easily. And you can do that by getting liquidity via equity. You can tap into equity through refinancing or getting home equity loans or partial property sale. So though property isn't instantly liquid, you can access the funds even if you're not at a particular age because it's your property, it's your investment. And you can access funds while retaining ownership or income potential of your property investment. So now, just weigh this opinion. about low returns on investment when it comes to pension funds, because poor investment choices or low interest environments can result in lower than expected pension growth. But with property, you have a potential for appreciation and cash flow. What you can do is that you buy properties in appreciating locations, then you reinvest that rental income. So you can benefit both from capital gains and rental income, which will often outperform pensions that may yield less in a low interest environment. You can't do anything if the government decides to change the policy and regulations surrounding the pension scheme, because governments may change pension rules, tax benefits, or retirement age, and this can affect your long-term planning. But with property, you have direct asset control, because you can invest in property in areas you understand and you can monitor. You are less affected by those changes in regulations in the pension laws, okay? And your property remains under your control and guidance. With pensions, we know that many pensions are tied to a single scheme or market, yeah? And this increases vulnerability to downturns. There's no diversification. But when you choose to invest in property, you can diversify your portfolio, which will give you stability. So you can allocate a portion of your portfolio to real estate, the direct rentals, or invest in real estate investment trusts or leases. I'll cover that in a different episode. So real estate is less correlated with stocks and bonds, okay? And it offers stability and cash flow even during stock market downturns. So investing in property offers real solutions to common pension challenges like what I've mentioned: leverage, inflation protection, income generation that is ongoing. It gives you your own control and you can diversify your portfolio. Of course, property brings its own considerations, like you have to manage and the upfront costs. But with smart planning, it is a strong and realistic counterbalance to traditional pensions.